The Supplementary Retirement Scheme, or SRS, is a good way for Singaporeans to save on taxes while saving up for retirement. However, did you know that as of December 2023, there's still 19% of SRS funds sitting there in cash? That's a whopping $1.2 billion just lying there, earning that tiny 0.05% interest while getting eaten up by inflation. That's why in this video, I'll be sharing with you all the available ways you can invest your SRS funds, whether you are a conservative investor or an aggressive investor. But of course, this is not financial advice, as you will still need to do your own research before investing in them, yeah? Also, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. Alright, first up on the list, we have the Singapore government bonds. This is absolutely the safest method, as it is backed by the full faith and credit of the Singapore government, which by the way, has also received the strongest AAA credit rating from international credit rating agencies. Now, there are three types of government bonds that you can invest your SRS money in. First, there's the SGS bond, which has a maturity period of anywhere between 2 years all the way to 50 years. So, this is good for risk-averse investors who just wants to lock in the high interest rates for as long as they can. Then, you have the shorter version called T-bills, which only have a maturity of either 6 months or 1 year. This is for people who are just looking for a place to park their money in the short term and have plans to invest their money elsewhere after that. For example, maybe they think that the market is too high now and is about to crash soon. So, rather than investing now, they would rather park their money into T-bills and see what will happen after 6 to 12 months. Lastly, you have the Singapore Savings Bond, which is sort of an in-between SGS and T-bills. That's because SSB lets you lock in the rates for as long as 10 years, while at the same time allowing you to redeem and get back your money within a month. This is good for investors who want to lock in the return for the next 10 years, while having the flexibility to withdraw the money whenever they want. As of making this video, all three bonds are giving around 2.7 to 3.1% return. Nothing too exciting, but definitely way better than earning that 0.05% return. Next, another way of getting guaranteed returns is by investing in something called short-term endowment plans. The way they work is rather similar to fixed deposits, where you lock your money in there for a certain period and get your money back once it matures. The nice thing about these plans is that they are protected by Policy Owners Protection Scheme for up to $100,000 of the guaranteed surrender value if ever the insurer boom and closes shop. So, there's almost no risk to you. However, there's good news and bad news. The good news is that some plans can offer a higher return than government bonds, like the NTUC Grow Capital East, which was offering 3.38% per annum for 3 years, or this thick 3-year endowment plan, which was offering 3.56% per annum for 3 years. The bad news is that they are not available all the time, as all the popular ones can get fully subscribed rather fast. So, you'll be left with the less popular plans like the DBS Savvy Endowment 18 and Great SP, which are giving lower returns than what the government bonds are offering. Besides the short-term endowment plans, there's also the long-term endowment plans. However, personally, I would just avoid them as they are not so liquid, have high fees, and tend to give low returns over the long term due to their more conservative holdings. Which brings us to the next option, cash management accounts. Due to the recent rise in interest rates, cash management accounts have been able to give up to 4+% returns. The way they do this is by investing in low-risk money market funds and short-term bond funds. However, the downside is that the returns can change from time to time and you may experience drawdowns when times are bad. For example, back in 2022, when the Fed was raising interest rates fast and furious, both Endowus Cash Smart Enhanced and Cash Smart Ultra portfolios saw some losses. However, if your holding period is long enough, this shouldn't be an issue, as they'll return back to giving positive returns. For cash management accounts, you have a number of options available. First, you have StashAway, which is offering 3 different cash management portfolios with projected returns ranging from 3.1% all the way to 3.8%. Then you have Safe Cash Plus, which is also offering a 3.5% projected return. And lastly, you have Endowus Cash Smart offering 3 different portfolios, with the lowest risk portfolio offering 2.9% to 3.2% projected returns, to the highest risk portfolio offering 3.7% to 4.0% projected returns. Similar to T-bills and SSB, While cash management accounts lets you earn a decent yield, personally, I feel that they are just a short-term place for you to park your money. That's because if you factor in the inflation rate, you'll be left with barely any returns. Instead, a much better place to use your SRS funds is to invest into the stock market over the long term. That's because even though the stock market can be volatile, given enough time, they tend to go up over the long term. Which brings me to the next choice, investing your SRS funds into stocks. For this, you can only invest into stocks listed on the SGX, such as those bank stocks or dividend stocks. However, this method isn't that great, as you'll be faced with two main issues. First, individual stocks can be subjected to corporate actions, which may give you some problems when you are investing with SRS. For example, if a company issues rights, you may need to top up your SRS account in order to avoid share dilution. But this could be challenging if you have reached your yearly SRS contribution limit. Second, given that the minimum amount to invest into Singapore stocks is 100 units and they don't support fractional shares, you won't be able to efficiently invest your capital, as well as any dividends that you receive. For example, let's say you have $15,300 in your SRS and you wanted to invest into DBS. You can only buy 300 units of it and you will end up with $2,700 cash lying around. As a result, sometimes you have no choice but to tanggugu and wait till you have enough money to invest. But nevertheless, if you still want to invest into individual Singapore stocks, you can use either POEMS Cash Plus or FSMOne to invest your SRS funds. POEMS charges a 0.08% fee, whereas FSMOne charges a flat $8.80 fee. So if you do the math, if you are investing less than $11,000, POEMS would be cheaper. And if you are investing more than $11,000, FSMOne would end up cheaper. There's no platform fee and no dividend handling fee to worry about. So that's nice. Now, rather than investing into individual Singapore stocks, personally, I feel that a better method would be to invest into ETFs and unit trusts instead. That's because 1. Singapore ETFs only require you to invest a minimum of 1 unit, while unit trust lets you invest with as little as $100 per transaction, which means you'll be able to use your capital a lot more efficiently. 2. You won't have to worry about any corporate actions. And 3, since ETFs and unit trusts are essentially baskets of investments, you get to diversify your risk across hundreds, if not thousands of holdings. For this, the 3 most common markets people would invest in would be the Singapore market, the US market, and the all-world market, where they basically invest in the top companies all around the world. There's no right or wrong here. Some people prefer to focus on the Singapore markets as they are more familiar with the companies here. Some prefer to invest in the US market for the high growth potential, whereas others prefer to diversify globally to reduce the geopolitical risk. If you prefer to invest in the Singapore market, you can either go with the SPDR STI ETF or the Nikko M STI ETF. There's not much difference between the two of them, as they are tracking the exact same index, have the exact same 0.3% expense ratio, and the dividend yield are almost the same. Or if you prefer to invest in the US market, the cheapest one to go for would be the iShares US Index Fund S&P 500. That's because even though it has a higher 0.08% expense ratio as compared to Amundi Prime's USA Fund's 0.05% expense ratio, it uses E-mini futures to replicate its holdings. So there won't be any dividend payouts, which means you get to save on the 30% dividend withholding tax. However, if you prefer physical replication, your next best choice would be the Amundi Prime USA Fund instead. And here's one possible good news. So far, you can only find the Amundi Prime USA Fund on Endowers. But as of early December 2024, someone spotted it on POEMS. This is fantastic because while Endowers charges a 0.3% platform fee, POEMS doesn't charge any platform fee for unit trust at all. However, while making this video, it seems like the fund is not available for purchase yet. So if it ever goes up, I will let you guys know, yeah? Lastly, if you prefer to invest in the entire world, and if you just want the cheapest fund, you can go for the Amundi Index MSCI World Fund, which only has a 0.1% expense ratio. However, it only tracks the developed markets and doesn't track the emerging markets. Oh yeah, this fund is indeed on POEMS now. I was able to choose whether to invest via SRS or CPF. If so, POEMS would be a cheaper platform to invest in this fund. If you also want to invest in the emerging markets, you would need to go for the Dimensional World Equity Fund, which has a much higher 0.35% expense ratio. Last but not least, if you don't really want to deal with all the hassle of choosing and managing your own investments, you can go with robo-advisors instead. The robo-advisors that support SRS investing are Auto Wealth, Endowers, StashAway, and Safe. But Kelvin, which is the best robo-advisor to go for? If you ask me, it's impossible to tell which is the best, as all robo-advisors have their own ways of choosing and managing their holdings. To know which is the best, you will need to compare them over long periods of time to see who can give the highest performance.
Ain't nobody got time for that.
So for now, you will just have to go with anyone that you prefer. But here's a pro tip. If you do decide to invest with a robo-advisor, what you can do is first move all your SRS funds into the robo-advisor's cash management account. That way, you'll get to earn a 3+% return on your idle funds. Then, whenever you are ready to invest the money, you can do a manual transfer to transfer your funds over to be invested. Otherwise, you can also set up a recurring transfer so that it will automatically dollar cost average for you. So, those were some of the best ways you can invest your SRS funds. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.